Day tariffs that were announced in April. But if you look at the overall trend, it continues to remain high at par with the levels that were there last witnessed in COVID. And if you look at the on the US economic policy uncertainty front as well, there also most of the whether it's the trade policy, monetary policy, or fiscal policy, all of those broader indicators indicate that the overall sentiments as far as the uncertainty are concerned, it remains high. And we continue to see every month of volatility that is there, with different announcements being made in trade and immigration policies by the new US administration, which has caused a lot of overall turmoil, whether it's the financial markets or the overall geopolitical environment in terms of various wars that have sprung up in the recent 3 4 months. So overall, if you see, the economic uncertainty does pertain into the system, and despite all of that, certainly uncertain times that we see, the strange thing has been that the overall global economic environment remains quite stable. And if you look at whether the various high frequency indicators, as suggested by the PMI numbers, there also, if you see broadly, the overall manufacturing or services sector progress has been quite good. Various agencies, whether it was the WTO or the IMF, they were expecting a large moderation in the growth in 2025 because of the new trade policy announcements done in the early part of this year. But we have seen that there has been a rebuff done in the overall investment strategies done by various investors and also by the households, in the sense of there has been a front loading of that of sort which is happening, and that as a result of that, we currently don't see that kind of impact in various high frequency indicators so far. And overall, if you look, the first half has been quite much better than expected. And as a result, I mean, if you see, the IMF and the WTO, they have revised upwards their projections for global growth in 2025. But then there are early indications that those fundamental changes that have been there introduced in the system, they are gradually seeping in with the data that is coming in.
Mr. Jasra, you're talking about global growth estimates, but the
Mhm.
graph that you're showing is on PMI, inflation, interest rates, and differential. Do you need to change that slide?
No, I was referring to that only, just to
Oh,
give
you're
it as yeah.
okay. Yeah.
So, that as a result of all of the indicators that we are seeing in terms of high growth, we see that the IMF projections have been high, and part of the reason also has been that if you look at the overall inflation levels, also they have not really gone changed very significantly. I mean, whether it's the advanced economies or the emerging economies, because of the low commodity prices that have been there. Also demand side problems that because of the demand side shock announced by the tariff uncertainty, the overall commodity prices have been low, and that has helped the central bank also in terms of maintaining their overall policy support that they can do to support the demand in the respective economies. And if you look at the ECB, in terms of the advanced economies, the ECB and the Bank of England have been quite supportive in terms of their overall interest rate policy, reducing it to the levels that were last seen in 2 3 years back of time. But Fed has been a bit of cautious because of the overall impact of tariffs that starts currently also is not very clear. And as where, I mean, they have also announced very gradual fall in interest rates, and they have said that they factor in one rate cut in this year and possibly maximum another of two in next year. So overall, if you see, there are concerns about the global economic on the global economic front, and also the geopolitical environment that is there. So that uncertainty is certainly the uncertain one thing that is certain at this point of time. Uh, and against this background, if you see the overall domestic economic environment, then uh, it shows stability and steadiness in terms of overall macro indicators and fundamentals. So, if I just speak briefly in terms of the overall backdrop, whether it's from the demand side, there you see we see signs of rural demand which is holding up, and the urban consumption growth, which was a concern, is gradually also getting corrected with broad basing of demand. And as a result, I mean, investment demand is also currently on the private sector because of the uncertainty. There's a anxious anxiety and a wait and watch mode for broader sectors, but we have seen some bit of recovery and good progress in capex by certain sectors. But it's still, I mean, overall, if you see, propelled by the government in terms of states, center, and also the public sector putting a good capex environment. In terms of
Mr. Zasrai, when you say what you see, we are not seeing anything. So do feel to
in
details, right? Because
yeah, yeah.
you may be
Hmm.
seeing graphs, but we are not. Okay.
No, this is just a,
Okay.
domestic background. There would be slides which would be covering about
Okay.
each aspect. So this is just a brief.
Okay, got it.
Yeah.
Good.
In terms of supply side, we see that the agriculture sector has shown good growth because of good monsoon, but there are extreme weather events which are a key monitorable that we see, and winter conditions also are getting prevalent in the northern part of the region. So this can be a good key monitorable for the agriculture sector. And if you look at the industrial sector also, I mean, it is led only by very skewed in terms of very small sectors, not in a broad-based way. But the key factor of growth propelling factor for the overall GDP from the supply side is the service sector, where I mean we see the new businesses also in the form of GCCs and other new businesses rising in the form of edtech, health tech. All of that is having that kind of impact on the services sector. So overall, if you see from the demand side and supply side, things are not looking that bad currently. And reason is that your services sector has been the key propelling factor. And one of the key beneficial factor also has been, which has helped the consumption demand pick up somewhat, get broad based, is the fact that inflation has something which has remained low, and we have seen that various food items have held the overall inflation levels to be benign. And because of the stance that was taken by the RBI earlier, the core inflation has held its way to around the 4% mark, which has also it has gone up some bit of it in the recent times, but overall it has stuck around that 4% mark because of the RBI's inflation stance, disinflationary stance that was done earlier. And because of the overall low inflation, there is a space of what we see is another max 25 basis cut in the current easing cycle, which has already seen 125 basis point decline in policy rates, and also which is seeping into the financial markets, etc. So overall, if you see, financial conditions also are not they remain volatile and dependent on flows. But overall, the environment is the system is flush with liquidity, and it is gradually getting prepared also with the kind of announcements done by the government also in terms of policy reforms measures, and the overall monetary easing announced by the RBI. So overall, domestic growth looks stable because of all of that. So now I will cover all of these aspects in detail. If you look at the overall demand side factors, where we see consumption demand would be the key driving factor again in FY26. We saw there was a great pickup in consumption demand in FY25, but we expect that momentum also to continue FY26, though there would be a small moderation. But nevertheless, I mean, if you look at the growth that has been witnessed post-COVID, then certainly it is quite good. And that also is gradually has helped certain sectors in the investment demand side, like power, oil and gas, and metals, etc. But that is not broad-based currently. And that's why we see that, I mean, investment demand would be faltering again with a 6.5 to 6.7% growth in FY26. And on as a result, I mean, it would be broadly led by the public sector enterprises, and also the state government and the union government. On the consumption side, from the government side, we expect that the state governments would also be maintaining that push from their side in terms of consumption, propelling the consumption demand. And so we expect that the overall growth would be around 4.3%, which I mean is in line with the trend that was witnessed earlier. Also around 4% mark is the overall trend growth on the long term basis. On the net export side, since we are a net commodity importer, this year being a very turbulent year from the external side, we expect that the overall trade deficit we expect that to increase about 20% on a favorable decline that was witnessed last. Now, the key factor is consumption demand, and the reason why we see that it would be remaining stable and in FY26 is because if you see there was a consumption demand and wage growth move in tandem, and when households feel that their income growth is quite good, pairing well, then they are also more confident in terms of spending right now compared to the future time period, and that's where if you see the growth also has moved in tandem with the consumption demand of the real wage growth. And if you see in FY24, there was a sharp decline, and as a result, consumption demand also weakened. But there has been a pickup post that, with the inflation levels also going down, and certain sectors also witnessing a good wage growth, which has helped the overall consumption demand also to pick up. And if you look at the recent high frequency indicators as well, then the quarterly numbers that are latest available from the non-financial private corporates, then if you see there has been a gradual pickup after a lull of from third quarter of FY24 about 3%. We have seen that there has been a pickup in wage growth that is happening. So from there are signs that the urban consumption is getting support from that. And also, if you see the rural wage growth has also turned not only positive but has stayed positive, and the growth has been currently at a multi-year high in the first quarter of FY26. So that is again because of a monsoon that happened very positive last year, and that is also currently expected to be there, getting a support from a good monsoon overall that played out. So rural wage growth is again propelling the overall rural areas in terms of consumption demand. And if you look at the consumption demand, then it is also important to understand the employment structure that we currently have. And if you look the employment data that is there from the PLFS, then one thing is there that more and more people are getting employed in the self employed structure, where I mean if you see mostly it is of the form where large people are mostly employed in MSMEs and other sectors. So there, that's where I mean that increase has been there, consistent increase has been there, which is something coming from the rural areas mostly. But nevertheless, that has been there. And if you look at the rural wage, regular wages or employed, salaried employed, then there has been a pickup in FY 2023-24 because of some bit of higher recovery also in certain sectors. But if you look at dissected further in the rural and urban areas, then as I mentioned, rural areas are the ones where the self-employed has increased quite dramatically. But then if you look, there has been also very small pickup in the salaried workers also. Nevertheless, a very small one, but it has been there. And on the urban areas, the situation broadly remains stable. Not much change has been there, but the self-employed structure has remained high because of as many people are also getting employed as gig workers, and there is a very high demand also from the e-commerce, quick commerce side, which is witnessing a very a boom sort of currently. And if you map the overall wage growth and the employment growth sectorally, then we see that during this period, shock-prone period of FY18 to FY24, then we have seen that the overall wage growth has been higher than the overall employment growth. So roughly around there has been a wage growth increase of wage growth has been around 5%, 5.5%.
Mr. Smith, if I can interrupt you, we have about 10 more minutes for your presentation.
Sure.
We have about 20 minutes. How many slides do you have in all?
There are 10 more, so I will cover it up.
10 minutes, that's
yeah.
fine. Okay.
So, if you look at the overall wage growth, then it has been led by the IT services that has witnessed a very good growth of overall high income, and the services exports also doing good. Because of that, the real estate and the professional IT sector and the business services segment, they have witnessed a very good growth in the wage growth, and employment growth has been also good. But there are certain sectors like manufacturing, where the growth, and also the public administration and defense, where the growth has not been that great in terms of both the wage growth and the employment structure. So that has been there. And now, if you look at the saving side of things, then uh, the households currently we see that there has been a fall also in the savings rate, and at the same time we are seeing an interesting trend where the leverage is consistently going up, which indicates two things. I mean that one, the households, they after reaching a certain level of living standard, they want to maintain that by taking they are by getting more confident in terms of taking more loans, and at the same time also drawing on their overall savings to finance that level of consumption. And at a time when the overall real wage growth, if you look at the overall long-term trend, and that has been around like 5% only, so not that high for various other segments. But nevertheless, we see that there has been a dip again in savings, which was consistent with the trend that we saw before COVID as well. And if you dissect the savings at the overall levels, then households are the largest savers for the Indian economy. But then, if you look at the other important saver, which is the private sector, they broadly has remained stable. But overall savings rate has remained around like 30.7% because of the fiscal consolidation and a laser focus of fiscal consolidation done by the government, where their fiscal deficits have gone down, and as a result, savings have broadly remained stable despite a decline in the overall household levels. And why savings are important? Ultimately, we see that investment demand is financed overall by the savings only. And if you look on the right hand side chart, then that indicates the overall dissection of the investment profile that we have in the economy, where if you look at the aggregate level investment rate, then that remains at 32%, reaching a level which was last witnessed a decade back. And that broadly is due to the fact of a high public sector investment that has been there, and also households with the higher income, they have with higher income recovery witnessed by the upper income households. The real estate sector has witnessed that kind of investment demand boom, and as a result, overall capex has remained higher compared to the stagnant period from 16 to 2021. And if you look at the public sector capex as well, then both the state, after the union government stepping up the ladder in FY22, the states have also increased their capex because of the capex loans that was announced by the union government. So that has also been a key factor. But if you club the public sector capex with the union government, then one thing you see is that it's just like a compensation being done by the union government of the trimming down that has been done by the public sector enterprises. So if you see the overall capex, then broadly it remains at the 5.5% level, which I mean it is lower than what we witnessed in the past 5 6 years time. So, but nevertheless, I mean it remains not that low, but not that high either. In terms of private corporates, we have the latest data by the NSO this year, which gave a broadly survey level data for various large private corporates, and that showed that the intentions for capex had increased in FY25 because of the gradual broad basing that we saw in FY25 in consumption demand. And if you look at the period of FY22-24, then our analysis indicates that the it was large firms were cutting down in their capex, but it was most overall capex growth that we witnessed. It was largely led by the MSMEs during that point of time. And if you look at the private sector data in terms of why that has happened, and why the current environment also is, which is focused on manufacturing, because it is the central point of the current US policy as well. And we have also like been trying to do push up our manufacturing sector since 2011, and also in the recent time PLI schemes were announced, and gradually we have seen that kind of impact where the overall organized manufacturing has witnessed efficiency gains because of, if you see the blue line basically indicates the output intensity, which is how much capital deployed into the economy is producing a high level of output. And if you look at the capital intensity, that broadly has increased on an overall level, but the increase in output intensity has been higher. So that indicates efficiency gains in terms of capital deployment. And because of the digitalization and the PLI schemes and all of those factors, the overall manufacturing sector is becoming not only capital intensive, but also the output intensity has been there. And at the same time, where we saw the labor productivity growth for the organized manufacturing decline during this shock-prone period of 15 to 19, we post-COVID, we have seen that pickup has been there in labor productivity for the organized manufacturing sector. And if you look at the other flip side for the private sector in terms of the services sector, then services sector continues to be the resilient one, where if you see the net services exports, we think that it would be touching a new record high because of the GC segment that has witnessed a good growth, and we expect that momentum to continue. Because if you see, this chart basically indicates the kind of export intensity is there in our various services sectors. And if you see, there has been an increase, tremendous increase in the export intensity or in other business segment, which is mostly comprises of your global GCCs basically, and also the transport sector has witnessed that kind of export intensity week increase. And the other important sector has been the audio visual sector, which is your the OTT platforms, etc., where there has been a lot of announcements and also new players coming up. So we see that the export intensity of our services is increasing, and which is a very good thing, and also a good spillover effect for the overall economy as well. Coming back to the investment demand, as to why it hasn't gone to a level which we require currently for a 8% or 9% growth. And the reason is simple, that that the overall policy environment is something which needs to be much more stable, and there are reforms which are to be done in terms of various structural reforms that have been discussed, and GST rate rationalization is one of them. But lower interest rates, if you see, are not they are a necessary condition, but they are not just sufficient for the private corporates to increase their investment intentions in a very long term basis. And there, I mean, if you see, the demand growth is also something which they want to get more broad based and also high on an overall basis. In terms of fiscal conditions, very quickly, if you see, post-COVID, we have seen that there has been a laser focus on fiscal consolidation by the union government, where there has been a drawdown on the overall revenue expenditure, and at the same time pickup in the capital expenditure. The same momentum has been witnessed by the union government in FY26 as well in the budget announcements. But states, on the other hand, have announced their plans in terms of pushing up their revenue expenditure, and also giving a boost to the capital expenditure as well. And states, if you look at the overall borrowing that are done by the states in the union, then states right now have their borrowing plans are now getting much more important in terms of the union government, because union government has gradually pared down its overall borrowing requirements, but states also have increased the tap the market for financing their overall capex and revenue expenditure as well. So their borrowing plans are becoming much more important. Uh, and just covering up the new announcements that were done by the US administration, then the remittances, we all know that it's a great stability provider for our current account and also the overall external demand at a time where there has been a lot of turbulence. And if you see, the right hand side chart basically explains the kind of how much relevance it has for the goods trade deficit and also the GDP, which has broadly remained. Overall trade deficit is something, the net remittances finances about 45% of that. So that is the kind of importance that is there in terms of providing us the stability at this point of time. And but if you look the impact of the H1B policy that has been there, then we don't foresee a very significant impact on the H1B visa policy, because if you look at the overall profile of the remittances from where we receive it, then certainly the US is the highest source country for remittances. But if you look at the H1B visa, various companies have already tried to pare down their visa requirements for that, and as a result, the overall hit would be broadly not very significant. In our estimates, it would be broadly under 0.1% of GDP in FY26, and there would be some impact in terms of the growth from FY26 onwards, where we expect the net remittances growth to half down to 5% from the earlier good growth of 10% that was witnessed on a long-term basis from FY20 to 25. And as a result, I mean, if you see the other flip side of the external demand, which is your how the current capital account flows are happening, and broadly the chart makes it very clear that there has been a lot of volatility, and also the blue line, which is the net FDI, which is very important from the private investment demand perspective as well, that has broadly been very stagnant and declined. There has been some pickup in the first quarter, but because of the overall global economic environment, the flows have been not very positive for us. It broadly has been quite negative, uh, but better than what earlier we were fearing it to be. Moving very quickly to the supply side
Mr.
in
Desai, how many slides do you have? Because I think you said
just
more.
yeah, just 2 minutes. Just 2 minutes. I am wrapping up very. Yeah. So on the agriculture side, the sowing season has ended well, and the Kharif sowing played out well, and currently also monsoon, the way it played out overall, it was above normal as the IMD had expected, and we see the reservoir position also, which has quite significantly, which will augurs well for the Rabi production. So agriculture growth is expected to be the trend around the trend level. But if you look at the industrial sector growth, that remains modest with the growth witnessed in broadly your infrastructure segment and capital goods segment. But certain sectors don't show that kind of high growth, so that broad basing is missing. On the services side, if you see, the services sector continues to show that resilience and stable growth, with good growth in trade sector and transport sector as well. And financial sector activity also remains though moderated, but not that low. So that is overall services is showing a very positive support. And another supporting factor, perhaps the more critical one, is the inflation level, which has remained quite benign because of the low food prices. And if you see, the wholesale prices also have been quite moderate because of the low commodity prices. And overall, if you see, the inflation levels being low has held also the consumption demand getting broad-based from FY25 onwards, and also we see signs of that happening in FY26 as well. But that has implications for the fiscal health, because we see that low inflation is also getting reflected in a lower tax collection for the government, which at a time when the GST rate rationalization has been announced, overall we see that there could be some challenges in meeting the fiscal deficit. And this chart basically indicates the overall inflation intensity, which if you see, the items which we saw a high inflation level of above 6%, they have reduced very significantly. In fact, if you see the green bar, then the items having 4% higher inflation has reduced to just about 20%, which was around 2.5 years back was above 70%. So that indicates the kind of overall broad basing disinflationary trend that is there at the consumption basket level. So against this backdrop, we see that the whole year of FY26 will witness a GDP growth of 6.3% in FY26, with it being led by the consumption demand at 6.9%. From the supply side, services would be the key propelling and resilient factor with growth of 7.3%. And inflation levels we expect it to be benign, with the retail inflation going closer to the 3% or perhaps even lower than that. And on the currency side, because of the volatility and uncertainty that is playing out, we expect it to average at about nearing at 86.9 in FY26. So current account deficit won't be much of a problem. It would be going up, but it would remain benign. So overall, external demand problems would be there, but currently the impact of that would be not very much. So yeah, I will stop here. Thank you.
Okay. Thank you, Mr. Desai. If you can stop sharing, please. We'll now hear from Mr. Vivek Jain, who is director at India Ratings and Research, and he's been associated with the company now for more than 12 years. Has overseen analysis in areas of energy, auto, and metals. He's earlier worked with Citibank and also Allegro Capital. Mr. Jain, over to you. And
How much
20
time?
minutes, 20 minutes or less, because we need time for
Sure.
questions as well.
Sure. I'll try to close this within the next 15. And please stop me if you can.
Your colleague took a little bit more time than.
No worries.
And-
Absolutely no worry. I think we planned it that way, so I think his presentation was long. I'll try to finish it early.
Yeah, please.
Sure. So I'll okay. Let me know if the presentation is visible, please.
Yes, please. Yeah.
Okay. Thank you so much. So I think the topic that I'll cover today is broadly twofold. One is I'll talk about energy and I'll quickly highlight the key points, and I'll also briefly touch upon the highway piece. So these are the two important pieces where we're seeing a lot of action happen, and hence chosen these two topics. The outlook that we have is largely stable for the sector. I think for thermal, we were negative for quite some time, but of late, for the last 3-4 years, we've been stable, for reasons that are known to one, but I'll cover them in the subsequent slide. Now, if you look at, there was a lot of, I would say, euphemism in terms or, excitement in terms of how the demand growth was happening. But of late, the demand has, fallen. And I don't think so that's a cause of worry because, we generally, when we model for a 5-year CAGR in terms of demand growth. And that is actually on dot at 5.5%, right, which has been the historical electricity demand growth also in line with the historical 5-year and 10-year averages. So not to worry about, but obviously, from what we were seeing at 8%, it has definitely been weaker in the FY26. If you look at even from January to June, that number was growth of just 1% with there being a significant uptick in the last month, which is June. Had you excluded that month, you would have seen a significant degrowth. But having said that, that was a monsoon impact. I think we expect H1, the H2 to be slightly better than what we were. But having said that, it's unlikely to cross that 8% mark. It will be significantly lower than that. And as I said, the long-term average still holds at about 5.5%. So we should be modeling for that on a long-term basis. If you look at, the thermal plants were written off. We had been shouting from the roof that, thermal will continue to hold on. At 54, we had even come out with a public report which said the PLFs are likely to go up. And, that is probably how it has played out. And now the share, the PLF stand at roughly about 70 odd percent. And I don't think so there's a big bull case for those PLFs to inch up because there's a lot of capacity which is coming on stream from all corners and sections of the power value chain. If you look at what has happened because of these two factors, you had low demand growth, and there was capacity which was available. The high merchant prices that you saw was a thing of the past. You had prices in the solar hours reaching actually low. I think which is still commendable because globally the prices are negative in some of these solar hours. So we are we are inching towards, I would say, low solar or day prices as compared to the evening prices, and that is why battery becomes a very very critical component of how we manage the entire energy chain in India. But just the message here being don't forecast very high prices on the exchange front. I think we see that happening often, but unlikely to hold on for a very long period of time. 28, you will see a lot of thermal capacity begin to hit the system, and that is when the prices will actually not reflect the demand supply gap which we saw when we had an 8% growth. So that change is likely to happen at the margin. If you look at the capacity share, I think it's often misleading, but I'll still caveat it. People say solar is the growth engine, which is true. But having said that, you should also look at the energy unit supplied. Right, from a net capacity addition basis, obviously solar will be the highest one, and that has continued to happen. And we are adding about 25 to 28 gigawatts of incremental capacity of all renewables put together. And our estimate is we will close somewhere about a similar flattish level, unlikely to cross that level, given that this year, Q1 had a lot of bunching because of the grandfathering on the transmission side. But you will be in the ballpark of the 25 to 28 gigawatt mark in terms of capacity addition. I think this is an interesting data point in terms of why the general question is why the preference for solar. If you look at from an observed data perspective, solar has been higher most of the time as compared to the P90 levels, while wind has been opposite. 63% of what we rate has actually been 90% of that P90 number. So you see a significant underperformance in comparison to the solar projects, and hence developer preference always has been solar, and that is why the grid disturbances were a very hot topic in terms of how the network planning was being done. And that is where the entry of FDRE or FTE, round the clock power come into picture, where renewables is now being spoken about on an equivalent basis to that of a thermal through RTC and FDRE tenders. And government, in the past had been coming out with tenders largely on the solar and the wind side, but of late those tenders have significantly changed, or the shade of those tenders have changed more towards FDRE and hybrid projects. Now, this is the slide that I talked about, the capacity addition that we are likely to see. You can clearly see a significant jump in capacity. We had about 900 gigawatts of stock of capacity, and we are planning to add about 50% incremental capacity to that of roughly about 450 gigawatts. And you can clearly see thermal is not left out, it is there. I think these numbers can see an upward revision also. So today we are talking about a 45 to 50 gigawatt. There could be a 60 gigawatt, number also that could be largely, being looked through. And the reason for choosing this sector is the capex amount that is being looked at, both from a renewable, transmission, hydro, is a fairly large number. So we are talking about roughly about 30 trillion as the capex to be added over the next 6-7 years in terms of this sector alone. This is the stock situation, in terms of what the under construction pipeline looks like, a fairly large pipeline. Now, if again, the need for why we say, this is an interesting chart. If you just look at it, it's typically called the duck curve of the power sector, right? So why the duck? Because the middle part is the belly of the duck, the backside, the tail, and the front, the neck. So what we're essentially saying is during the hours where you see that red line, the demand is largely met by the solar generation, and after that the generation drops, and hence the intermittency or the variability in the generation is fairly high, and hence you would want to solve for that. Now the solution that has been evolving over a period of time has been either you do PSP, which is pumped storage, or you do battery. Now the way things are progressing, it looks like battery will gain traction, and this was the chart that I was talking about in terms of how the shade of the tenders on renewable side has transitioned significantly. So if you look at, we were doing about, if you take 22 and 23, we did about 16 and 10 gigawatts of ordering, the total tender activity, and just look at what happened in 24. This was all an outcome of the demand growth that you were seeing at 8%. The states were running helter skelter, if they had to face blackouts. I think that was a situation that everybody wanted to avoid, and you ended up signing or ordering about 38 gigawatts while the demand then faltered. So we are seeing delays in terms of PPA signups and all that happened because you were preponing the demand, which was not likely to sustain at those levels. And now the ordering activity is somewhere about that 30-35 gigawatt mark, maybe closer to 40, but the growth will come slightly over a period of time, not immediately. And you can clearly see the shade of the projects also, quite a bit changing. So the blue bar that you see, that's the representation of the hybrid or the more complex projects. So you can clearly see what was about 5-6% in FY19 is clearly now, 70% in terms of what the ordering is suggesting. If you look at the next one, so this is the tenders which have come out, and a very, very good sign for the government on the sector at large, because the way the pricing is now behaving for the storage tenders, it is a fairly competitive pricing, and most of the players I would feel are tending more towards this bit, because the cost which is now in further recent tenders in 25 is coming closer to 2 rupee 25 paisa or 250, which is a very amenable tariff for storage solutions to be offered, and you will see a significant pickup. So that is one area where we see a definite pickup in terms of capex happening. This is just a unit economics of how this pans out, but yeah, happy to discuss that subsequently. This is the trend on the solar tariffs. They've averaged down, but I think right now we're not seeing a significant change in tariffs. That's largely to do with how the solar prices have also behaved. We are stabilizing at somewhere about 250, 260 broad range, though the module prices also, as I said, is a reflection of how the pricing environment behaves when we build. On the wind side, the prices have inched up. So what they were earlier to now, and largely driven by a function of what's happening on the capital cost. So capital cost, which used to be about 6 crores, today being talked about at 9 crores, 8.5 crores, or depending upon location and player specific conditions. So you're looking at a tariff of about 350, 360. And wind has made a comeback. It's made a comeback because now we are talking about FDRE, more complex projects, and not just solar, which we showed was the preference because everybody said that the volatility is lower and hence you would prefer solar. In terms of just the smart meter implementation, that's another area where the government is focusing upon. The smart meter implementation has picked up, but still slower than what one would have loved. But it's a very good initiative, I would say, because you're targeting the demand management side, in terms or the supply side. Sorry, my bad. The supply side, because there was a significant amount of leakage happening, but now you're targeting that leakage, and through this installation, you can even move ultimately to time of day metering, which is the ultimate goal of how this eventually could play out. So I think there's a fair bit of pickup, but still slower, but moving in the right direction. On the transmission side, nothing to really call out for. I think some of the state projects, we've seen very specific issues with respect to state projects in terms of their ability to collect receivables, but otherwise a largely stable sector, which allows for a very high leverage to be brought onto the sector. In the next 2-3 minutes, I'll quickly cover the road one. In terms of the road sectors, the award activity, which is being talked about also, has come down. It is not at the same pace. If you look at 24, we were doing about 33 kilometers a day. Today we are down to 29, which is largely held on, largely to remain same. Given the risk profiling that had happened in the sector, or the risk dynamics, the way they played out, I think in 2013 we had the BOT model as the preferred model. Then we moved to the EPC model, and now if you look at HAM and annuity have become the preferred model. But there is some resurgence, I would say, of the BOT model again. Because in this particular model, the HAM model, the returns are largely fixed the way you bid. But in BOT, there could be both. You play the upside as well as the downside on your account. So given the balance sheets are healthy, I think we see some bit of excitement in the players to even take up the BOT projects. Whether that will be a successful venture, still to be seen. But I think that's a trend that we are seeing emerging, where BOT is making a comeback, and also from an NHAI balance sheet perspective, maybe they're looking out for more BOT projects. If you look at the total cost, or the cost per lane kilometer, that also largely has remained the same at about 6 crores per lane kilometer. 6 crores per lane kilometer. And, the capital cost is about, so that's the number, which includes, everything. So, all the things. And now, if you look at the monetization pipeline of NHAI, that's also looking fairly, decent in the done monetization also, either through the InvIT route or the TOT, toll operate and transfer route. This is one bit of area where we were slightly concerned, and we have been raising this point. The award activity, given it has not picked up as we discussed in the prior slide, the number of bidders is definitely, on the higher side, and the intensity has not, come down. So we still see a fairly large number of participation by newer sponsors, which is leading to some bit of pricing pressure, as well as the way the projects are bid out. You are seeing those pressures build up, and even in terms of the margins that the EPC guys are reporting. So I think that is one risk to call out for, and which is also clearly visible in terms of the average number of bidders. So that intensity is at 21. So one project gets about 21 bidders on the max, and on an average basis, if you look at, the number has trended up from 7 to 13. So which clearly shows there is increased participation by a lot of these smaller guys. Now, Morth also recognizes this and said, was looking at the fact that, no players who don't have a track record come into the picture, and that is why they made certain changes. We can discuss them if needed, but I think the idea was to have players who have more experience, and there are lesser delays in terms of the execution timelines that they have witnessed in their prior projects. So this modification was not done in July 25. And just maybe the last slide, if you look at the two routes we have seen the HAM projects take, they're largely either they have followed the monetization route, that is they've sold the asset, or they have gone and topped up the asset, and whatever is the top up available, they have moved that money back at the parent level. So both these routes are available, and we've seen a very active usage, I would say, of both these routes. In the monetization side, you have private InvITs and public InvITs, where most of these investments have been sold to. And on the top up side, this is just a category wise bifurcation of the total balance completion cost. BCC is the balance completion cost to the debt to that particular ratio. So lower the number, the better it is, because you're carrying lesser debt against what is to be reimbursed to you by the agency. So these are the trends that we are seeing. And last slide on the airport sector, I think it's a typical sector where you have that 5-6% growth, and you see variations in those growth depending upon how and at which airport you talk about between the domestic and the international traffic. The interesting trend there is again the discretionary spending. Where we are looking at a significant pickup in terms of the non-aero revenue. So, which used to not be so substantial a portion of the revenue stream is now beginning to look a substantial portion, and there is a lot of traction or a lot of activity happening by almost all the developers to make sure that the non-aero piece as a percentage of the total revenue inches up significantly, because that calls for a higher ROE as compared to the base business ROE, which is the aero revenue piece. So I think overall we are seeing fair bit of traction. Just to summarize in three sectors as per us. One is energy. I think is seeing a big transition, and capex along the entire value chain, whether it is capital goods, equipments, you name, and there will be a capex associated with that particular stream. The second one where we see pickup, likely to happen, because that is where that growth will come in, because consumption, as far as was explaining, is being a bit slow. So government capex will really need to step up. And the third is activity on the airport side. And within energy, a large bit is being taken about by the battery piece. And as we move toward more complex projects, I'll just stop here. Yeah. Thank you.
Thank you very much, Mr. Jain. I think very good presentation. We have, I think, let me see, we have about 20 to 25 minutes for questions and answers. And I'll request the audience to start posting your questions in Q&A. Let me begin, however, with a few questions myself. First, about the overall economy presentation. So you're expecting GDP growth more or less to remain similar? Is that the net takeaway?
Look, Alok, the forecast which Paris has put on, or what India Rating has, that was revised post the 50% tariff came into existence.
Okay.
There is some water has flown in post that. The first quarter GDP number has surprised everyone. If anybody says 7.4 was their expectation, nobody is going to believe it. Nobody is going to believe it.
Right.
So there is a bump up because of that. So what we are looking at, a situation, the growth coming somewhere around 6.5% to 7% kind of range for a relatively longer period of time.
Right.
Now, if I put it forward and look at slightly medium term kind of view, how can we break that shackle or come out of that 6.5% to 7% kind of growth?
Yeah, I mean, so I was going to ask you that how do we do that, but I was also going to say that there are many countries who would be very happy to be in that golden shackle.
Yeah, many countries will be very happy, but we are not.
Okay, right.
Right. Now, look, if you go in the past, when the things were difficult, we had the highway program starting somewhere in late 90s or so. So when there was a growth slowdown, then till 2000 or so, we had this National Highway NHDP program that gives the kick up to the growth. Then came the whether one likes it or not, the Manrega. Then came there. So these are the things which moved economy by creating demand. Yes, government is putting that kind of money in by this fiscal stimulus. But right now situation is fiscally we are stuck at 4.4 or so. Economy has gone more than the real. The problem is nominal. We are all jumping up and down, very happy that inflation has come 1.5%. The kind of destruction, I'm sorry I'm using this word, it is going to do the fiscal health. Because the budget has assumed 10% tax growth. If the growth remains, nominal GDP growth remains less than 10%, then we are going to have a very difficult time to match that 4.4% target. So what we have to do, what has happened, the inflation has gone down, your real has gone.
Yeah. So one question. So would you say that your tax growth and nominal growth, is that generally a one-to-one relationship?
See, ideally, your what we in public finance term call the buoyancy has to be more than one.
Okay.
So buoyancy one means if you have not changed any taxes, you haven't levied new taxes,
Right.
the rate at which your economy is growing, your tax collection should grow at the same rate. If it goes at a higher rate, this means your tax administration is working efficiently.
Okay. So therefore, the issue, if I understand it, not the issue, but we have real economic growth, which is not 8 to 9, it's 6 to 7, and the inflation is, not 5, 6, 7, 8, 9. It is 3, 4, right? So that's causing
No, even less than that. If you look at the first quarter GDP deflator, it is what less than 1%.
Yeah. Okay.
Now that is a problem.
Okay.
So economy like India need at least 3 to 4% kind of GDP deflator growth, which is at par with somewhere around 4% of WPI and 4% of CPI. Then you will have the 4%. So if you're looking at simple arithmetic, if you are growing around 7% in the real term, around 4% is your GDP deflator growth, you will be growing at nominal at 11%. Whereas this year, we may be struggling to grow even at 10%.
Right.
So you are looking at a tax collection which is much lower, which may be lower than what we had budgeted for in the central budget, and the same is there for the state budget.
Okay. All right. I think there are questions that are beginning to pour in now. So I'm just going to ask one question of my own and then take audience questions, and I'll come back to you on a couple of other things also, Dr. Pant. Mr. Jain, very quickly, I'll just ask one question, and more we'll take from the audience. This year, whether you look at peak growth or energy growth overall, there wasn't that much. But is that how much of that was driven by the fact that the weather was relatively better, right, more benign this summer, or not? Or are there fundamental factors at play, as in greater efficiency, less manufacturing demand, or is there something like that?
Right. So I think, we don't model it on a year-to-year basis, as I said, so we go by how the trajectory has been over the, on a CAGR basis. I think it's more palatable because, it's similar to saying 1 year could be very good and the other could be very bad. So similar, I think what was have witnessed in 24 also. So 24 was a very strong growth. So the base got increased, and hence you're seeing that 25 numbers pan out. But definitely, I would say, if let's say 100 was to be the marks that were to be allotted to the degrowth, that we've seen, probably about 25% you could attribute to just the monsoon, bit, because the temperature.
So if you are going forward, what are we looking at? 5 to 6%, 6 to 7%, 8 to 9%? What are we looking at?
Yeah, so I think we model it about 5 to 6% kind of a growth on a 5-year rolling CAGR basis. So that will be the base that will get set for this year.
This is correlated to about 7% GDP growth, right?
Yeah, 7%
GDP growth.
Yes, so about 0.8 times.
Will get more, right? Okay.
Yeah, correct. Absolutely.
I think we can almost have a separate whole discussion on that. Let me take some audience questions, because otherwise we'll run out of time. So I'll request short answers, because lots of questions are pouring in now. First one is from an anonymous attendee. I don't know why they don't want to put their name. Do you expect the RBI MPC to change stance to accommodative along with 25 basis point cut in the current easing cycle? Dr. Pant, I'm assuming is for you.
Quickly, so 25 is the max which can easing which can come at in this current cycle. Now that will be data dependent, whether it will come in December or whether it will come in February. It will depend on how the data will pan out.
Will it change the stance?
Unlikely.
Unlikely. Okay.
Unlikely. They will continue to maintain the neutral.
Okay. The next question, which is also from somebody, I don't want to give the name. Given the changes in GST rate structure and the federal sharing structure, how much fiscal headroom will remain with the center and the states in order to keep infra spending up?
So they will continue to provide wherever they can crowd in private sector investment.
Mm-hmm.
Now we should understand it, because at the end of the day there is a limitation to which government can loosen its purse.
Mm-hmm.
Right? There is no unlimited, because ultimately end of the day that has to be funded by borrowing, and the borrowing has a cost. It is what we'll borrow today has to be paid by our next generation in the form of interest. So they will continue to remain somewhere around five and a half kind of center plus state put together, and try to put in the projects whereby by putting money by the government, the private sector money comes in.
Okay, I have a follow-up question for you. How
Yeah.
much of the increase in state borrowing how much of it has to do with greater need, or how much of it has to do with greater ability, as in their finances are better, they're able to borrow more?
It's you can say both.
Okay.
The need is there because ultimately, if you look at the development expenditure, say whether we talk about health, we talk about education, other than there are roads other than the national highways, right? There are state highways, there are district highways, there are rural roads, and all of these are built by the state government. So if we are talking about improvement in infrastructure in India, we should not be focused only at the national highways. Now, the next round of infra requirement after road and power is taken care of is going to come from the urban infra. Now, the urban infra, if you have a sewage treatment plant, unlikely that there will be a user charges, or a stormwater drainage, there will be a user charges. These has to be funded by the state. So that's the next big infra spending, which is going to come in the case of India, and for that they will continue to follow.
Okay. The next question is, do you expect the government to meet its fiscal deficit target for 26, given the income tax relief and the recently announced GST rate cuts?
And more on top of it, I'll add the slow growth of the economy.
Absolutely.
Growth
What you mentioned a short while ago.
Yeah. It will be touch and go, because you know what has happened. If you look at revenue deficit, unlikely to be met, but fiscal deficit, yes, because we had a good performance in the non-tax revenue. In your what we say that the capital receipt, right, where disinvestment and everything, government has already done closer to 50% in first 5 months.
Okay.
Any big ticket sale or 4 or 5 medium ticket sale, we will exceed the target of 47,000 crore. Out of 47,000 crore, they have already done roughly around 23,000 crore. So these two gives some hope. It will be touch and go. If we look at the second your advanced tax estimate, the income tax which are growing somewhere around in a single digit. Second advanced tax estimate suggests that it is growing at somewhere around in excess of 11%, and that gives a confidence. By day after tomorrow, we'll know how the numbers pans out, but it will be touch and go for 4.4.
Okay. Next question. This is for Mr. Jain. Does thermal tariff of upcoming bids at 60 rupees a unit versus hybrid of 4 per unit, meaning RTC, does it make sense to still continue capex towards thermal capacity versus cleaner resources?
Sorry, just one clarification before I answer this. So if you look at, the comparison, I'll do like to like. So if you look at thermal tariff, that's at 575 for 6, so fairly correct. If you look at the hybrid one, right, so there's an input tariff because you're supplying, solar in a particular hour and then taking it back in later hour, right? So that cost will be 2 rupees, let's say, bare minimum 2.5 rupees. Plus, I'm saying the conversion cost is about 2.5 to 3 rupees. So net it's closer to 5 rupees is my submission. If you compare that 5 versus let that 6, now there are two choices that we are making here. First is one is an intermittent source of power. You're only talking about other is a long-term firm supply. Battery allows you.
Therefore, you're okay with the capex towards capacity.
Yes.
Net, yeah, okay.
Yes.
Pratyush Kumar, we have a name, thankfully. What are the segments that will see significant demand growth in Indian Railways and metro sector in light of railways undergoing modernization and the aim to become a net zero ecosystem, and India is slowly becoming an export hub? To some degree, the answer is already in his question, but Mr. Jain, please.
Yeah. So I think broadly, this is unlikely to be that infrastructure play that we have seen on the, the highway side, because that's more privatized. So you can play the, theme through participation in InvITs and some of the other projects. This will be more like a capex-led theme. So you're looking at companies which support the capex that is being done on the railways, because privatization on both, the metro side has not been so successful as one would have thought. The two metros largely are, not making the money that was initially envisaged when they were, conceptualized and handed over to the private guys. But in terms of areas that we have, I think largely, if I recall, Kavach is one major one. Then you have electrification, new line construction, and some of this, modernization of locomotives and coaches was one. And from a budgetary allocation perspective, we're talking about 2.65 lakh crores for the budget this year versus 2.52 that we had the year before. Yeah.
Okay. Question for you, Vinod Mehta. Since we have reasonably good coal reserves and low on elements required for battery, would it not be better to optimize the energy basket with moderate share for thermal and battery and gradual shift to more RE plus battery?
So that is exactly, how it's probably shaping out. I think good, Vinodji, that you brought it up. So I think coal today also, we talk about the capacity share, but if you look at the generation share, it's still at about 65 to 70%. Renewable is still at about 18 to 20 odd percent, though inching up. But just from a perspective, generation basket is still a major dominant share. And given the coal reserve that you rightly pointed out and the GCV of coal that we have, it is far more amenable to have electricity produced through coal, just that the CO2 emissions have to be taken care of, which they are now after you install the ESP. So I think fairly with you. And battery, the choice that some of the other countries are making, because you need to stabilize the grid, we will also have to make that choice.
Okay. Question for I guess Dr. Pant. The household saving growth rate is coming down. It's a healthy sign from the consumption-led growth point of view, or will it adversely impact our long-term investment potential? Is it positive or negative?
It's a negative. It's a negative because what has happened is the Paras had shown a chart where the household savings have come down to 18.1% and personal loan to GDP has gone up to 17.4%. Now, there is a personal loan as in relation to GDP has become doubled.
Mm-hmm.
Now, that is, what is happening right now. The EMI is eating out the disposable income.
Mm-hmm.
Now, because of that, you are looking at a lower household savings.
Mm-hmm.
It is impacting our consumption, and in turn, because what we have the same. See, you have if you go to standard textbook economics class of class 11th or class 12. Macro identity saving minus investment is equal to current account. Our savings are going down, right? So investment is nothing but saving minus current account. Current account is going down, savings is going down, or investments are going down. Okay. So with the lower savings, if our investment goes up, then this means a large part of that investment is getting financed by the foreign savings, and that will be disastrous for Indian economy, because we can't afford more than 2.5% to 3% kind of current account.
Okay. Question for Mr. Jain. Will the push for clean energy also result in reduction in road infra usage in the near term? I can't see the connection, but maybe you can, Mr. Jain.
No, I think what maybe the only connection that I've heard is as the renewable bit picks up, right? We're talking about more EVs, if that is the direction the question is intended to. But I think even from that perspective, EV is still some distance away, and people traveling, I don't maybe that is unlikely to change even if
but even if you had more EVs, that would not mean a reduction in road infra usage.
Absolutely, yeah.
Maybe the person who's sent this question, maybe they can clarify that and send us another follow-up one. Next one, in the current geopolitical environment, growth drivers like export-led growth are getting impacted. Will the sectors like roads and ports be impacted in attracting investment? In fact, I was looking at that because when you're looking at sector by sector, I was seeing that the ports growth was a little bit less than what we were, I guess, hoping for. Yeah.
Right. I think it is a very valid.
Sorry, we have. Go ahead. Sorry, you are in and out, Mr. Jain. Maybe you can switch off your video and speak. Yes.
Now emerging. I think the only function the way they are. right? So not an immediate impact, but over the long term, if definitely yes, so that would be my reply. You have sectors like pharma, which are still doing well. You are exporting them. Autos you export, and there are sectors from which you import the heavy metals and all, right? So all those will continue the way they are because they're still doing despite the 50% tariff that is applicable. But some sectors get impacted, maybe to textiles to a certain extent, and some of the other sectors.
Okay. Dr. Pant, in addition to impact on remittances, what is the impact that you expect on services exports in coming years if the US implements the Hire Act to curb offshoring?
Before answering that, just if I just add to what Vivek has just said. Now
Right.
we have only first month data which has come post 50% tariff, and tariff YOY decline in exports to US is 12%, which is much lower than what everybody was expecting to begin with when 50% was leveled. Yes,
Right.
this is lot of base effect is there because what we did last year or so, and overall exports has grown up to say gone up by 6% YOY. If you look at first half this fiscal, exports to China has gone up by somewhere around 22 to 24%. So there is some of the reallocation or say alternate markets, but not to the full extent we are able to find out. So this is what is on the export side. Now, yes, if there is tax imposed by the Hire Act, but if you look at, I'll take you back right from the Obama's time. Obama first presidency, Obama second presidency, and then Bush, and then Donald Trump, and then the Biden came. Offshoring has always been a hot topic. Despite all this, the data center in India is getting investment is coming in. Apple is ready to pay $25 billion additional tax rather than relocating manufacturing from India to the US. Yes, there will be some impact, but it is unlikely that the impact will be whatever we are offshoring will become zero.
Okay.
Because at the end of the day, those companies will be looking at their bottom line.
Okay.
And their profitability. Why the offshoring started on first case? It started because they were able to do the same work in India. By the evening in US evening, India's morning. By the time the US opens next day, their entire things is processed and they reduce on that time. Now suppose that time is taken in the US to do the same work, there will be at least 1 day lag, and that will reduce it out the productivity. And if you look at the Indian cost in India are much lower than what the cost in US, the entire profitability of the US manufacturing or US services sector are going to go down drastically. So yes, there will be some impact. It will not be correct to say no impact. There will be some impact, but unlikely it will be very significant.
Okay. Mr. Jain, that person has clarified his question. He said, apologies if the query was unclear. If there is a likelihood of transition to a mass mobility or railway heavy mobility led, will that lead to infra spending in the near future? So I guess, if we have just energy transition, which is that we have more mass transit on one hand, and on the other hand, freight moving to railways, I guess that if freight moves to railways, obviously, I guess road infra usage comes down. But are you seeing any signs of that?
Not really. I think it dependent on the lead distance, right? And those things are pretty, sorted. But in case there are, and mass mobility, I honestly don't think there's an immediate risk, from this. If I were to, just answer it in a yes or no.
Okay.
Sir, just to add from the railway side, because your dedicated freight corridor has started. And it took us more than what time we initially thought of.
About 15 years.
Yeah, 15 years more. But now if you look at the kind of goods movement happening there on the dedicated freight, it is mind-boggling. They are growing at 20-25%. Begin with, because of base, it has gone even by 40%. So there will be some shift of bulk goods movement from road to rail, and so that's on the railway side.
Okay. The next question says, how will the proposed change in toll collection to a payment as you go model impact the infra players?
This is the FASTag one, right? The upfront payment that they're now collecting.
Right. Yeah.
So I think if you look at it from both the perspective, right? The government gets a float money, right? So they're collecting the amount upfront, so you get a float, and not sure if many people will be able to use the entire 200 trips. But if you are able to use, then it's a win-win for you. It's you win a fairly decent amount in terms of what you would otherwise paid. But immediately we don't see, if the question is whether you see any increase in terms of number of trips and all, I don't think so. That is going to happen immediately. Maybe in order to achieve those milestones, if some people have that compulsion and they feel that they need to travel more than but otherwise our impact assessment which we did a wire also is probably neutral on this. We are not
Who keeps the extra money? Is it the government or is the infra players?
No, it is not the infra players. The money goes to the government because you're collecting on behalf of the government, so it goes to them, right? The toll whatever that upfront FASTag money is collected.
Okay. Okay, so we're done with the questions from the audience. Unless there's one more, there is. Sorry, it's done. There are couple of questions I have. Since we have, let's see, how much time do we have? Okay, we are actually at 4:15. Just one last question from me to Dr. Pant. Dr. Pant, we're beginning to talk about how can we unshackle ourselves from that 6.57 growth. And could you develop a bit further on that? I mean, would it come from private investment, government investment, consumption? Where would this come from?
See, there is...
Sorry,
if you look at
twofold question. One is the type of investment or consumption, and two is the sector, as in services, industry versus agriculture.
If you look at from the production side, it will come mainly from the services, but it has to be supported by manufacturing. Because if it is not supported by why I said this, if you look at the private final consumption expenditure, general notion we have is about the goods, right? Manufactured goods. But more than half of our consumption expenditure is on services. It was, I think the latest number, it was around 51.6% or close to 52. It's more than half of consumption expenditure in India is services. So it is bound to come from services. But we can't afford a situation whereby we have only the services growing, but not the manufacturing. This means what it is telling us that we are leaving a lot of people away from the development or from the growth process. Because we all know, we talk about the penetration of anything, whether we accept mobile, if we leave it, the television, whether it's even now television, refrigerator, air conditioner, cars, we are way lower than the many developing economies. So if that manufacturing doesn't grow, then this means these people, everybody is not getting fruit of economic development, and that disparity in the economy are rising. We have to focus some more on the labor intensive, because with the AI, and we know that technology is a great stabilizer. We have seen in the telecom space, right? There's no need to take the name of anyone, but we had seen how the telecom space has changed. What we used to have a decade back, right? Yes, from 16 rupee incoming mobile call to now whatever, almost the free incoming mobile call. But look at the kind of players we had there and the kind of number of players we have right now. So we have to, unless we take focus on A, the skilling, B, looking at the domestic demand, because your export demand is there today, it may not be there tomorrow. We cannot go and create demand globally. Create domestic demand, how to bring in all the people, those who are left out from the economic growth or economic development process. That's the key challenge. If that happens, then only we'll have a sustained. See, mind you, even if we have the 7% sustained growth for a decade, right? That means we are talking about per capita income in rupee term being the 2.5 times of what they are right now in a decade's time. Yes, The people at the bottom end may not grow at 2.5 times. They will be around maybe 1.7, 1.8. So at the upper end, it may be 3 or 4 times. But that is what is required.
Okay.
So I don't know whether I've
Okay.
given answer to your both
I think
questions
you
or
have
not.
given- yes, yeah, we can. Thank you very, very much. This has been very, very good, and lots of questions, lots of answers. And we are very grateful to Dr. Pant, to Mr. Jain, and of course to Mr. Jasrai for stepping in there and making the presentation. And thank you to India Infrastructure Forum members for joining us today. I think for most of the session, we had well over 100 people there. We still have 95. And thanks again. Iqbal, what is the next event that we have?
Infrastructure finance.
Yes, so we have December when?
December 5th.
Yeah, so the next in-person event we have is on December 5th in Mumbai. It is India Infrastructure Finance, Infrastructure Finance in India conference for the forum members. But I'm sure between now and then we'll have either a virtual event or an in-person event with Niti Aayog or one of those agencies. Right? Okay. Thank you again, and thanks for joining us. And
Thank you.
See you next event. Thanks, Dr. Pant. Thanks, Mr. Jain.
Thanks for having India Ratings. Thank you. Thank you.
Recording stopped.